A trust is a structure where a trustee holds assets for the benefit of beneficiaries. It's commonly used for asset protection, estate planning, or family businesses. The trustee manages the trust's assets and distributes income to beneficiaries. The trustee can be an individual or a company and is legally responsible for managing the trust. Beneficiaries are the people or entities that benefit from the trust. They receive income or assets from the trust as distributed by the trustee based on the trust deed. The trust deed is the legal document that outlines how the trust operates. It specifies how income and assets are managed, how beneficiaries are chosen, and the powers of the trustee. Common types include discretionary or family trusts, unit trusts, and fixed trusts. Each has different rules regarding how income and assets are distributed to beneficiaries. In a discretionary trust, the trustee has the discretion to decide how much income or assets each beneficiary receives, offering flexibility for tax planning and asset distribution. In a unit trust, beneficiaries, called unit holders, have fixed rights to income and capital based on the number of units they hold. This structure is common for investment purposes. In a fixed trust, beneficiaries have a fixed entitlement to the income and assets of the trust. This structure provides less flexibility than discretionary trusts, but more certainty. Trusts themselves generally do not pay tax. Instead, the income is distributed to beneficiaries who are taxed on their share of the trust's income at their personal tax rates. Beneficiaries must include any distributions from the trust in their personal tax returns. They are taxed at their individual marginal tax rates, depending on the amount received. If the trustee retains income rather than distributing it to beneficiaries, that income is taxed at the top marginal tax rate of 45%, which is significantly higher than individual rates. Trusts are subject to CGT on the sale of assets. Beneficiaries may be liable for CGT on distributions of capital gains, but CGT concessions may apply, such as the 50% discount for individuals. Trusts may qualify for small business CGT concessions if they meet the eligibility criteria, allowing reduced capital gains tax or deferral on the sale of business assets. If the trust operates a business and has an annual turnover exceeding $75,000, it must register for GST and charge GST on its products or services, submitting regular BAS statements. If income is distributed to a minor under 18, it is taxed at higher penalty rates to discourage income splitting. A small amount of income is tax-free, but larger amounts face higher rates. Trusts cannot distribute losses to beneficiaries. Instead, losses are carried forward and applied against future profits within the trust, helping to offset taxable income in future years. A trust deed can be amended, but any changes must comply with the original deed and legal requirements. Trustees should consult legal professionals before making significant changes. Trustees are not required to pay superannuation for beneficiaries, but they must pay super for employees if the trust operates a business, subject to Australia's superannuation laws. In a discretionary trust, a family trust election can be made, limiting beneficiaries to specific family members. This may provide tax advantages, such as access to certain tax concessions. Trusts provide asset protection, as assets held in the trust are typically not considered personal property of the beneficiaries. This can protect assets from creditors or legal claims. Trusts are commonly used in estate planning to ensure assets are passed on to future generations according to specific wishes, offering control over how assets are distributed. Some businesses combine a trust with a company structure. The company acts as the trustee, providing limited liability to the directors while managing the trust's assets and income. While trusts offer flexibility and asset protection, they can be complex and expensive to set up and maintain, requiring professional advice to ensure legal and tax compliance. Trusts offer flexibility, tax planning opportunities, and asset protection, but come with complexities. Understanding the tax implications is key to maximizing the benefits of this structure.